Hotep there, Brother Will. Hopefully this helps you out and those who trade. I remember you were asking about the, what can give you kind of a good gauge is where markets go. I always say the cost of money. How much is money going to cost you? It couldn't be any simpler. If money's going to cost, when I say money, I'm talking about interest rates. I'm talking about dollars. If you're going to put up a business and you know that interest rates are going to go up, that's the cost of your money, which means you're going to have to raise prices to cover that debt. It couldn't get any simpler. A lot of folks try to complicate it, and of course you can by introducing derivatives, swaps. Which makes a lot of sense. Which for one reason, and I think I was talking to Brother D about this. When I'm looking for sectors that might go up or down, I want to see, are they involved in interest rate swaps? And interest rate swaps, gosh, try saying that 3 times fast, especially after drinking some whiskey. And I don't drink, but the thing is if you have interest rate swaps that you're swapping out a fixed or a variable rate for a switched rate in order that you think interest rates are going to rise, that kind of tells you that if a whole sector is doing it, and then you gauge that upon how are their credit derivatives, are there credit derivatives that are trying to insure that debt because they think that sector is going to have some issues when interest rates go up. That's going to tell you the cost of money is going to go up for that sector. So then you can start looking at shorting if the candidates in that sector that can't cover those costs. Because they're going to have to go into the debt markets to try to go ahead, and they're going to have to pay higher debt, which means they're going to have to raise their prices. And when you couple that with the whole economic environment of folks are going to go into this higher interest rate environment, when the cost of money goes up, they're going to have to move those prices. You remember, they instilled this inflationary environment by keeping interest rates real low. And one thing that I did, and I've been telling folks a long time, I've been saying this forever, and now you start seeing it on CNBC. It's amazing. I've seen more analogies that I put together on CNBC. I just saw one on one of this floor trader. He's like one of the number one floor traders. He's been, it's hilarious. That's, but it's kind of flattering, when you start seeing a lot of these analogies show up on mainstream media or in the mainstream of the economists or floor traders out there in the CME or whatnot. It is kind of flattering. Anyways, I like to watch, I like to see where's the cost of money, and if somebody's going out there and whoever's insuring that debt, I want to make sure, because if they have to insure somebody, they're going to have to pay more for that insurance because they have a feeling that entity is going to default. So it's literally what it comes down to. Look at the cost of money. Bottom line. It's so simple it hurts. Then you can start looking at the things of, the cost of their suppliers. If somebody makes, tires, if the cost of rubber goes up, that's going to affect them, which means they're going to have to raise the cost of their tires. If the cost of rubber goes down, they're going to try to keep those margins low, and they're not going to lower the price, but at least that means that if the cost goes down, they have a lot more cushion that they can work with, which means that company more likely will have they'll be a little bit stronger. They can pay off their debts, which means they'll have a lot of working capital to do other things, which means they'll be able to most likely pay off better dividends, it's one of those things where I try to gauge it to where what is going to cost and how bad are they in debt, and have they dug themselves out of debt? How much cash do they have? Are they able to pay their shareholders, the folks, because they're saying, hey, so I always look at the cost of capital, and then the cost of insuring that capital, the credit default swaps or whatever. I just like to know what is it going to cost. Anyways, here's one of the gauges. I did this a long time ago when I was teaching during the sessions. And basically, I used to look at timing charts, and I used to look at the TFC charts, which is nothing more than, the TFC is futures. But I had learned from Paul Britton over there years ago. Gosh, this must be almost over 10 years ago now. He's with the commodity trading. He's got a whole thing. It's out of Vegas. He's got his. But one thing that stuck real well with me is the three sisters of inflation: soybean, silver, and sugar. And what that is that points to, and the reasons were that they gave at the time. And again, nothing is guaranteed, is etched in stone because we live in a dynamic world. So, the three sisters of inflation are going to change from time to time. But, the thing that he had said is, of course, when you start seeing those things go up in tangent over time, you're going to have higher prices, inflated prices. Because, those are the things that are used more often than not in products. Energy, precious or industrial metal, and sugar's used in everything. And right now, I can't find a cheap enough contract to trade sugar, so I use corn. So I'm trading the XC as well as the corn contract itself, and I'm looking, this charting package I have, I'm looking at, just how I could, because I like the fact that I could gauge where I could get in and out using timing, whether it's RSI, and I know, Brother Allen, you're loving the RSI, hopefully. But I use the RSI for everything. After that, the brother out of Kenya, Eric Muwatha, I gotta tell you got to go to Muwatha.com. This cat is like a trading genius. I mean, he's like a walking money machine. When in terms of using the RSI, he uses it for stocks and for his thing. I mean, he just knows the RSI. It's a different thing. I don't use his methods, but he just got some really good, he knows his game, Anyways, what I'm looking at is, this is what I used to teach a long time ago, and I learned it from, I'd say I like using it for different reasons, but this guy used it for a different reason. The COT, all traders know of. But, I like to really make it very simple. What is the cost of money? And a lot of folks are gonna feel the effects of this. At least guys like you and I have the heads up. And when it comes to this and geopolitical events, let me take a side note. These clowns over in NATO are poking the bear, and that's not nice. I would not poke the bear, because the bear ain't gonna attack like they think. I'll leave that on the other channel, and I can get more into the geopolitical aspect of it. Plus, the two con men out of Greece, Cyprus and Varoufakis. If you ever watched The Sting, the one with the very first one, Paul Newman, Robert Redford, that's telling you what's going on in Greece. The two leading figures in Greece ain't nothing more than con men. You can't trust Southern Europe as far as you can spit. But I could leave that for the other, because it's going to affect most everybody in America. And I haven't been wrong yet on the geopolitical front as to what's going to happen. I'll leave that for the other channel, for the rant channel, where there's a lot of four-letter words and stuff like that. But folks better get ready for some serious fireworks. They gotta get ready. Anyways, let's get back to the charts. Basically what you have is, here's the Fed funds rate. Okay, of course, the cost of money. That's all the Fed funds is. Because remember, the dollar is the reserve currency at the present time. We'll see what the AIIB. Oh, speaking of which, that is gonna be I'm gonna tell you, I'll leave that for the rant channel. That's gonna affect a lot of people. And I hope a lot of our folk can grow up and, realize that they have the ability to do this, but, I guess empire is a little too important. That's for the rant channel. But they're about to learn a hard lesson. My mom used to say it, a hard head makes a soft behind, and you're gonna have probably about 40 million of them coming up real quick. I know Brother K and Brother Keith, you know what I'm talking about. Hopefully. Anyways, the cost of money. Fed's funds rate. Of course, this is where the Fed funds, they kept it almost at nothing. Okay? Because remember, 99 is, the lower the price, the higher the interest rate. So if it's at 100, that means if it's at 101, it's negative rates. That's basically what the contract is. The lower it goes, the higher the rates. Okay? And if you see what's been happening where it's been trending lower. Okay? It had been trending lower, if you notice. which means that they're anticipating higher rates. Now, I look at the COT as more of a macro, kind of like okay, this is the environment. I also use what's called sentiment when I like to use it. This has a sentiment indicator for like currencies and stuff, and we'll get to that later. There are certain, then you can go to the timing charts, I mean, it's just a very broad base, but it gives you kind of like a pimping out in the game, like they say in the hood. It gives you kind of like a tale, as they say in bull riding or the country and western guys. These are tales of where things in the world can go. Fed funds rate, until the AIIB and others and other variants, which are like the Central Eurasian currency that Russia's playing. I'm telling you, don't poke the bear. Russia's playing a serious game. Don't let this AIIB and the Central Eurasian currency so far, that mechanism, don't let that get a hand. If that gets out of hand, all I can say is I hope folks got passports. Anyways, no, I'm just being facetious. Basically, you got the cost of capital you're seeing the cost of capital go up as the price of the capital goes down. It's like a seesaw. Something that a futures trader just used because he saw one of my reports. I'm telling you, these folks are using a lot of this stuff now, and I didn't know that until just recently, which is good. I mean, it's out there. They won't get the Grail, but they'll just get this. Anyways, the thing I taught a long time ago is you have the commercials, the hedgers, the folks that don't necessarily need to trade. They just need to hedge whatever they have. Even though you can't really hedge the Fed funds rate unless you're like a central bank or something of that nature, and you try to find, different ways of trying to hedge, all this interest rate environment. The thing that I think I talked about a long time ago think of interest rates as being a ball. And I think, Brother Dietrich, I think I told you about it, as being a ball held at the bottom of a pool. And you hold that ball down, but sooner or later you're going to get tired and it'll have to normalize. Again, normalization of price reaching the mean. You're going to hold, when you let go, it shoots up out of the top of the pool. Well, think of interest rates and what the Fed funds and all these other individuals did over the years and what's happening right now in the opposite side of the dollar as you're seeing this currency war go down. Think of it as they were holding down a beach ball instead of in a pool. They were holding down a beach ball about the size of the New Orleans Superdome in the middle of the ocean. That's what's going to happen. And as they let that go, think of that as being the cost of capital. They held it down. The cost of capital. You can get cheap dollars and fund all these projects and do everything you want in all these other countries and, bling your money away and shoot. Watch Empire to the time and Scandal till the cows come in. Well, let me tell you something. Interest rates, they're having to let go of that ball, and the thing is, they're not strong enough to hold that ball, and economic forces always normalize. So when they hold that ball that's the size of the Superdome coming out of the bottom of the ocean, what's going to happen? It's not just going to go 2 feet above the sea. The thing is, you'll probably go ahead and knock the moon out of its orbit. That's what the cost of capital will do. When you watch the cost of money, Brother Will, you can almost gauge where things are going to happen. This has just been something that's been going on for, been charting stuff since, of what had happened since the 1700s to now. And you're starting to see there's different ways of gauging the cost of capital because they didn't have the Fed then, but there are ways of where commodities and the cost of those commodities then under the cost of things now. It's telling you. You do a chart back in the 1700s to now, it'll tell you, it all says the same thing. When they let go of that beach ball and they're letting go, and it's kind of hard to hold on, they're trying their hardest to hold on as they start seeing things, but they're going to get the bends. The Fed will get the bends, bottom line, but they're not the only ones. Those that are subjected even to the other side of that trade, that have financed all that stuff, are going to get the bends. And that's why you're seeing a massive rush toward this currency devaluation as on this side of the teeter-totter goes up, the other side of the teeter-totter goes down. Folks are going to have to adjust their budgets, whether it's Slovenia or whether it's Ghana, whether it's Australia or whether it's, New Guinea, or whether it's, Sweden, whether it's France, or whether it's, somewhere in Mongolia. Everybody's going to have to adjust for the reserve currency being let go at the bottom of the sea. Okay, and it's going to be quite the event. It's going to be an event. I'm telling you, it's gonna be, you know, I'm thinking of going to Vanuatu and moving over there and just kind of watching it and get a front side seat. You know, hopefully everybody was able to recover from the cyclone over there. You know, a lot of brothers and sisters got hurt over there. But anyways, the COT chart. Let's get to the chart. Over here you have what are the speculators. Basically these guys provide the liquidity for these guys to hedge. The blue hedges and the red. So if you literally all these contracts equal, basically they normalize themselves to zero. So whatever's above, I don't look at the red because those are the guys that are always losing. The red are the small traders, that are trying to trade. They have no clue. The green always has a clue as to where things, most of the time, I should say the high probability of the time they have a clue because they have to hedge the bets the green has to hedge the bets of the blue. The blue are their hedgers, the central banks or whoever, the big money. And basically what they do is they have to, like if they, have a gang load of corn, or let's put it in terms of Rim Empire. They got a gang loader, they're a rim manufacturer. They manufacture the rims. Okay? They want to make sure that the price of rims goes up, that they take the opposite side of that so they can, they of course they want the rims to go up, but if the rims go down, they want to have longer contracts, they want to buy, short contracts and so those short contracts they're buying are going to buy from the other side, basically, they're trying to buy to protect themselves in case rims go down. So they're going to say, okay, I'm going to buy a short, therefore I'm protected if rims go down. Sorry, I didn't want to confuse you. I'm confusing myself. Don't worry about it. So it's, so basically, if the price of rims and bling goes down, they're going ahead and making sure that they're equally hedged, so therefore, they're not, so cause it's hurting their production, they took all this money to make these rims and all of a sudden it went down and they're like, oh man, dang, I'm losing cash, Rashad ain't buying rims like it should, oh man, I'm losing money. So they're buying these short contracts to hedge themselves on that cost, okay? These guys are the ones on the other side of the trade, okay? I like to look at that, and if you notice, every time the market goes up, the green went up, and as the market starts to and I'm not saying it's a perfect match. Like right here, of course, you start seeing the market level out, but the interest rates are going up. That was the anomaly in 2009 when Barack said, "Hey, I'm done with my golf game. Hey, Fed, Bernanke, do what you want. I'm going out," and the Fed just went and said, "We're going zero. We don't care." And equities and everything else went up because money was cheap and you can buy everything you want. Okay. Just very simple. If you notice right here, as the green was going up, as you start seeing it, the market started to react after it went up. And as the green starts going down, the market, of course, it was continuing up, but then all of a sudden it kind of reached that point where it's okay. Now I think it's basically, green is like kind of leading you as to where things are going. They're trying to lead you. As the green went up, it said, okay, now market. It's kind of like a momentum, kind of like a yo-yo or a slingshot, It went up, and then all of a sudden the market says, okay, now it's time to react with it. Okay, I'm not saying it's always this way, but I just noticed more often than not that's been the case. As you started seeing the blue go up, it started leading the interest rates or the price of the bond down and the price of the interest rates going up because they were talking about the taper. And they were this was before the taper. They were talking. They were more like saying, okay, well, we think that forward guidance. They were using the term forward guidance a little bit more. As you started seeing the blue go up, you started seeing all of a sudden the interest rate started saying, ooh, wait a minute, the interest rate should go up and the price of the cost of money should go up and the price of the bond started going down. And we're starting to see the blue pull back. Now I'm not saying it's going down, but the blue might be pulling back. It might be saying that maybe maybe we just kind of, like, again, a pimp announcing the game, we just kind of spooked them into the markets of thinking that interest rates would, that interest rates will be going up, but not now. Again, it's just the cost of money. I just like to look at the cost of money, and see who needs that money the most because that's going to cost them the most. And are they in a position to pay off their debts And if not, that's a good shorting opportunity, because pretty soon they're, going into the debt market, they're going to have to increase prices and stuff. And if they don't have enough folks to buy it, then they're going to have some issues. Notice, and I was taking a macro view back to 2009 when I was showing you this. Now, look at this right here. As you start seeing the blue, which is up, which you notice in the Fed funds rate going up, because the interest rate is now starting to trend down. And this is a very lagging. When I say lagging, it's it's not there till the week. I think they released it. Was it Tuesday or was it Thursday? I can't remember. They release it. And basically what it is it's released after the data, but it's a macro view. It gives hedgers and everybody else. It gives that REM seller enough. The guy that's selling the REMs to Tyrell or Rashid. He's just saying, okay, all the traders saying, okay, this is what we commit to. This is what we think that's happened, and what we're kind of thinking we're going to allocate cash because of what's happened. It's very lagging, but it's a very good macro indicator. This is just one out of many that I use. Notice how the blue is pulling back, which means that, hey, maybe that this was just a spook environment to spook folks into thinking, okay, get ready for interest rate rises, but we're not going to do it in June like we think. Like everybody's anticipating, like everybody's been screaming about, oh, interest rates are rising in June. Oh my gosh, run for the hills. We can't pay off our weaves. I'm being facetious. But the thing is, and that's for the other channel where I can get more expletives and more real. But the other channel is more for folks who want to know what's going to happen in the world. Because if yours truly tells you it's gonna, believe me, it's gonna. And I'm talking, oh gosh, a lot of stuff coming out of Venezuela and Colombia right now. Very important. Anyways, I'm looking at the cost of capital might be going back down, because if this goes back up, that means the interest rates go back up. I'm not saying that, and I'm just talking not necessarily what the Fed has done, just where the traders are saying, we think the futures will be. We think that this is what may go down. And keep in mind, they got a lot of deeper pockets than anybody that's presently on Facebook right now, except for Zuckerberg. So they have a good idea that because these are the guys that produce the things that we need across the world. They have a kind of an idea that and I'm talking the blue, the hedgers, they have a kind of an idea where they want to hedge what they're doing so they don't lose in productivity or whatnot. But anyways, I'm not saying that the green will go back up, thus driving the guys to think interest rates will go down or the cost of capital being cheaper. I'm just saying you're starting to see it normalize a little bit, because this right here was definitely, where they were talking taper. It started spooking the markets. And when it spooked the markets, of course, interest rates went up. Or at least the idea of protecting against interest rate rises. I shouldn't say interest rates going up, but the idea of protecting of the aspect of it. And then you saw the Fed funds fall. But this is something I've been using quite a bit. I also we can look at the euro, which is or the dollar, it doesn't matter. The dollars, I like to look at the sentiment. And this is, okay, I should have gone to the sentiment of the Fed funds contract. We can always go back to it. But this chart takes a while to load. This guy, he's been doing this for years. Great chart. Okay, this is Euro contracts. And again, the Euro contracts kind of, let's wait. It's going to take a while because we're still in the Fed funds. It's going to take a while to load. In the meantime, I got knocked out of a little trade. I'm going to see if my trigger came in, or if I had a trigger, but it's not. Okay. Had an hourly chart going in. No trigger yet. Nothing major. We'll see. Anyways, using the sentiment on the euro. Give it a minute. Takes a minute to load. I'm trying these new charting packages, and with these new charting packages, it's okay. Good, sentiment's loaded. No, it isn't. Okay, I thought it was. This guy's chart. His thing takes forever. And let's go to 3 months on this while we're waiting. You may hear some background noise. I'm seeing this. This guy's saying stay liquid and don't dismiss the value of debt in retirement. Oh, interesting. This guy off of CNBC. Okay, this is our 3 month. This is my sentiment chart as well. I just want to see the sentiment. They're only 40% bullish on the euro, sentiment wise, but the sentiment is starting to. If you look at the blue at the very bottom, they're starting to rise from where it was at earlier. So I'm not saying that the euro is going to go back up, but it's just rising as of the last couple of weeks. And a lot of that was due to the Fed speak and whatnot, especially if you look at what's happening here. But notice that the big traders, irrespective of all that happened, Fed speak and everything, if you look at the blue at the end of the chart, the blue line up here, and look at the green, they're still expecting dollar strength and euro weakness, i.e., this taper talk is starting to make an effect. Remember, the cost of capital, or the dollar going back up, is starting to make folks kind of think, oh, I think irrespective of the fact that, futures are thinking that maybe they've normalized this a little bit, interest rates may tend to start going up. Now, if we look at the dollar, keep in mind that the euro is only 56% or whatever percent of the dollar. The dollar kind of leveled off on all that talk. And that might be there. So there's some divergence there, and divergence between the interest rate chart, which we start seeing a little bit of normalization going back toward, or normalizing where it was recently, going back toward lower interest rates, or at least waiting for the interest rate hike, but or at least waiting to lift that ball, to get that ball from the bottom of the sea. We're starting to see that manifest itself in the dollar. It's leveling off. If we see the hedgers have leveled off. When I say hedgers, I'm talking the big commercials, the big guys, not the large specs, the speculative, the traders. I'm talking the big guys, the ones whose pockets are so deep that, they're starting to see, and it's leveling off a little bit, that they're saying, okay, maybe the dollar's not going to rise just as much as, it's not going to rise or fall, because remember, the dollar fell here where that little spike was, where that little enthusiastic flash crash, if you want to call it, and then it went back up, and then it went back down. So this chart pattern right here, the cost of capital is leveling. It may go back up, which means that when the dollar starts going up, that means the cost of getting those dollars go up. I also like to look at energy, which is crude oil, which is the opposite of the dollar. And I saw that on I've been telling folks that a long time ago, but every trader knows this. It's nothing that's, specific to any one person. If you look at the year to date of the oil contracts, and again, I like to use the electronic contracts, and I hope I got an electronic contract. Let's see, no. Let's get an electronic contract. I like the electronic and not the pit traded. Even though, it's 6 and 1, it doesn't want, it's just more liquidity into the, electronic contracts. If you look at this, notice how the big traders are saying, not the whales, not the hedgers, not the big guys, not the ones who's got deep pockets, but the big traders are still thinking that even though that leveling of oil is happening, we're starting to see oil start to take go down. At least they're starting to say, okay, when these things start to trade places, and we're starting to see, when we start to see level go down, or oil level out and go down like this, that means dollars should level and start going back up, which means that the cost of dollars, which is great for folks that drive, or anything in the economy. Of course, when oil goes down, it kind of helps you out and it makes your dollar stronger. So you can purchase, multinationals that have international footprint that actually are export or have a higher export to import ratio. They're going to be doing quite well. The ones that are hurting, that have international footprint, that have, that are selling stuff in that local currency and depending more on that local currency than what they have been able to fund those things in dollars, that they're funding it more in the local, things are going to be a little bit difficult for them. Matter of fact, they're going to probably get a little bit pissed at the guy that's selling rims to Tyrell and Rashid. I'm being facetious. I can't wait to put this rant on this other channel because the other channel is going to be a little bit more hardcore and it's going to make a lot of folks, it's going to piss a lot of folks off, but it is what it is. I can look at soybeans and sugar. I like interest rates. Let's go to the interest rate because this is long enough. And yours truly, I like to be very loquacious. Let's look at the 10-year. And, again, the other channel, if you get on it, Brother Will and Brother D, it's going to piss a lot of folks off. Hey, I like that. But it'll make them think and it'll probably put some money in their pockets. That's all at the end of the day, it's like, can I put some money in your pockets? If I piss you off, so what? Anyways, if I'm looking at this, the interest rates themselves, not the Fed fund rate. We were looking at the Fed funds rate, of course, which is the cost of money, basically, which was how I look at it. But I like to look at the interest rate environment. Okay? Now, these are the bond. This is the 10-year. We can look at the or the 30-year, which is, but I like to look at the 10-year bond. That's basically where, think of it as the 30-year is the big fish eat, but think of the 10-year, or think of 30-year is where, you have only the Neiman Markets. I don't know. I've never shopped at those, or the Saks, think of it as the expensive store. Not a lot of folks are going to go in there, the expensive mall. What's that mall down there in Atlanta? There's one that's like extremely expensive, and and then you got the one where you can tell that it's like, they have, the Starbucks index or the Peace Coffee index when it was, if you start seeing, there's not a lot of them in there, but there's a couple here and there, but they got a lot of more Sears and JCPenney's, but they're pretty good. There's like one mall, and I can't remember it, it's in Atlanta, and those of you in Atlanta know exactly what I'm talking about. It's not the mall, but it's like the mall where everybody goes because it's not too expensive. It's kind of like the Goldilocks. The porridge ain't too hot and ain't too cold. It's not like a strip mall down there where they have a lot of dollar stores, a couple liquor stores, and there's always a brother hanging out there saying, hey man, I just need some bus change because I got it, and he ain't doing nothing more than he's going to buy some beer with it. Or a couple of Lucy's. There's not that mall. You see like your occasional Vietnamese store there. It's not that mall. Okay. It's not the mall where you walk in and all of a sudden, there are no security guards because they don't expect anybody to do anything crazy. This is that mall that I'm talking about. And it's one in Atlanta. Oh, it's not the Peachtree. Please help me out with it, Brother Will. But anyways, if you look at this, this is that mall where, they have a couple of security guards because they know somebody might go buck wild, but they're not because, it's like the most used mall. The 10-year notes are the most used mall. It's that one in Atlanta, and it's going to drive me crazy because there's two of them that I know that are in what's the district where it's like kind of a higher end district, but it's not like seriously higher end, but a lot of folks like, they have the Starbucks quotient is there. Anyways, if I see the 10-year go up, okay, and this is the most used mall, that means that it's telling me that the cost of money is going down. It's again like the Fed funds rate. It's like, okay, interest rates will be going back down. They're not going to go up as much as people think. People shouldn't freak, okay? It's not going to be a disaster, let's go ahead and get, let's refinance the house now because interest rates are going through the roof. Now, I'm not saying they're not. Because right now there's a lot of taper talk. And not just talk, they're actually tapered. They've been tapering for a while. They've just been using every other mechanism to fool the public. But the thing is they're actually from de facto to now we're going to do it hasn't really materialized just yet, but it's going to materialize. I think that mall is next to the W. It's kind of near the W. I remember that much. Because it took me forever to try to find. I remember because I walked all the way back from this. I took this. Did I take the train? No, there's not a train. No, I walked back from. I took the bus and I walked all the way back. Yeah, because I did take the train somewhere, I think. Then took the bus back to. Because I'm always looking for Somalian food or just wherever there's African food. I'm always like trying to find either that or soul food. And I remember that. Taking it, I think it was near the W. I keep wanting to call it the W. There's a lot of hotels there. But it's that one mall. Please help me out. Have me remember that. Anyways, if you see the 10-year yield, or the 10-year, this is not the yield, this is the cost. The cost is on the other side of the seesaw is the yield. If you start seeing that, that means that the yield will go down, which means that, okay, I can, maybe I can wait a week before I refinance. That kind of mentality. Or I better pay off that credit card. Maybe I can wait another month. But here's the caveat. Even though we're starting to see it kind of level out, and we're starting to see this kind of level out, it doesn't mean it can not go the other way. Look what happened here. It kind of went like, oh yeah, okay, interest rates. And then what happened? Bam. It started going the other way. And the interest rates, the thought of interest rates started going up. So I'm not saying it's not going to happen. Okay. This could be a flag pattern to go with further down. Okay. Which it looks like it's setting up to be. That this is nothing more than just what traders would call a flag pattern to go down, which means interest rates will skyrocket and they'd have to let go of that ball. Okay, think of this as the strength of how they have to let go of that ball. That's all this is. Now I can go, and I don't want to make this is a very long video. I don't want to make it extremely, but it's giving you kind of the idea, Brother Will, of the cost of capital. Think of this. Every time it goes up, that's how strong they are to be able to hold that ball down in the middle of the sea. And think of this. This is 2014. They were holding that ball down. Look at that. They really held the ball down. They were able to, and keep in mind, the ball's not just going to be held down. They literally have to, it's a bond bubble, basically. They literally have the strength to hold it down. But pretty soon, and keep in mind, the ball isn't just like staying in one spot. Currents and stuff make the ball go up and down a little bit, but they're able to hold that ball down as much as possible. And I'll show you on a 10-year chart how well they've been able to hold that ball down. As soon as the chart, let's do this. So, okay, it's going to take a minute. So we can actually see, about 10, not 10, but close to 10 years. Because this is a 10-year chart. I like to say what they're looking at in the future. If you look back here, look at how high interest rates were back here. As opposed to, of course, we had the crash in 2008, and they had the come in and QE everything and QE it up. But notice what we're starting to see, a behavior change. Notice how the behavior is starting to change. If it starts to go down from this point, that means that we're really starting to see that they can't hold that ball down. And those folks that have credit cards, us that have mortgages, folks that have bought a house, a boat, folks that are, have taken out a lot of loans that are variable for, whether it's for, commercial producers of corn, Apple, Google, I don't care who you are. When those interest rates go up, it's going to affect you in an enormous way when they can't hold that ball down. So to answer your question in this extremely long video, Brother Will, and we can get more in depth as to what I look for and how you can trade that, because everything can be traded. Remember, the green is kind of a precursor that tells when the market's going to start going up, and the blue is a precursor. When the blue is up over it, it's a precursor to tell you when the market's going to start going down. Notice how the blue started leveling out, and they were kind of, you get these little bumps. The blue went up, and it told you as soon as the blue went up, it told you to start looking for the market to come down. Again, these are just literally like a pimp announcing the game. It's not telling you exactly when the blue goes up, that's when the market goes up, or exactly like right here, the green started going back up, and then the market finally started reacting. The blue went down, and then the market finally started reacting. The blue goes up, is kind of telling you to start looking for small times where the market goes down. And I'm talking the market in terms of bonds, and the 10-year bond. The blue is now sustaining itself going up, and it's starting to look like, even though we had that tiny little blue going down, it looks like the blue is wanting to make us, and look at the height of where the blue is at, as in the past, where they were holding QE and stuff. Look at the height of the green, as where the green heights are in the past. Look at the green, as when the green lows were in the past. So we're looking at an environmental change, but they are going to raise interest rates. That's a given. The timing is another thing. Just the level and the effect is another thing. It's not it's basically, when I was watching this thing out of Korea, and the Korean bankers are waiting to say, and it's not just Korea. I got stuff from Uzbekistan, Korea, Russia, a lot of stuff out of Russia. I can tell you what's going on. A lot of folks are going to want to know this, but that'll go on the other channel. They better know this. It'll go on the other channel. Venezuela, Dubai, Saudi Arabia, Ghana, Zimbabwe, you name it. A lot of folks are anticipating. A lot of stuff out of Kenya and Nigeria too that are anticipating. That's for you, Brother Keith. We can probably talk in the Skype circle with that. A lot of folks are anticipating. Their thing is to what level, to what rate. In other words, if they can let that ball go up, which it's going to do, therefore it doesn't hit the moon as interest rates with normalization would do. If you just let it go like you would normally do it, then it would hit the moon. But if you have that, again, that ball the size of the Superdome at the bottom of the sea, if they let it go up slightly as it's going up, then interest rates are going to pop through the surface. And hopefully they could only pop a few feet at the surface depending on how they let the ball go up. Well, that's literally what they're looking at right now, is how can they let the ball go up? And that's when you started seeing fluctuations in the markets. I don't know if they're strong enough to because if they let it go up too fast, keep in mind, they're tethered to that ball. And think of it like a ball going up and their foot is tethered to that ball. They're going to get the bends. Okay? The entire globe does not want to get the bends. Because they get the bends and you see what will happen. That's why you have the AIB coming out and all these other currency mechanisms and digital currencies, because everybody's expecting the world to get the bends. I'll leave that for the other channel because it's something that's going to affect folks. And folks that aren't ready, and folks that aren't cognizant, all I could say is, just find yourself a good religious leader and just talk to him for a minute, because you're going to want to find a priest or a imam or, or a rabbi or whatever to talk to you, because you're going to want to talk to them. Believe me, you're going to want to talk to them, and, or find a tooth fairy or the Lucky Charms leprechaun, because you're going to want to talk to somebody. Okay.